Hey, what's up, everybody? Welcome to Bullish Rippers. I'm Evan, better known online as Stock Market News. Today, for you, we have a conversation with ETF company Roundhill. Roundhill has multiple thematic and sector-specific ETFs covering a lot of areas I'm personally interested in, including esports, sports betting, streaming, pro sports, and the metaverse. In this video, we're talking specifically about their new meme stock ETF, ticker MEME, but we also touch on a couple other topics, including retail trading and how ETFs work in general on the back end. Nothing in here is financial advice. Make sure to do your own research. Make sure to check out Roundhill, and finally, make sure to like and subscribe if you do enjoy the video. I would love to throw it over to Will or Mario now and kind of talk a little bit into the meme ETF, the meme index, a little bit behind what kind of inspired you guys for this, and maybe a little bit about the purpose of what you guys are trying to do with ETF.
Sure. I'll start. This is Will speaking, and then Mario, feel free to chime in. So I think at the very highest level, we started looking at creating the meme index and therefore kind of the meme ETF in March, April timeframe. I think we actually reserved the ticker symbol meme sometime in April. And just for a little bit of context and background on myself, I had been, I think Mario probably even longer than me, someone that paid attention to Reddit, to Wall Street Bets. I think I looked the other day and I joined Wall Street Bets sometime in late 2019. It would kind of lurk on there and started to kind of appreciate the power of social media and kind of leading up even before kind of the GameStop AMC explosion in January, February. You could kind of see that there was something going on that was different fundamentally in kind of what was driving short-term and even longer-term, price movements in stocks. Now, that being said, I'll date myself a little bit, but, when I first started trading, it was, instead of it being, Reddit and Robinhood, it was Yahoo Finance message boards. And I think I used an app called Scottrade. So kind of the general concept here is something that kind of has been going on for a while, but it wasn't until recently that you could kind of even begin to think about quantifying the concept of social media sentiment. Back then, the word meme didn't even have a meaning, but it had always been something that kind of had impacts on markets, and clearly this January, February was kind of the most pure expression of that. But I think for us, we really saw what happened with those single name securities and said, there's kind of this different factor in markets that's not quantifiable via, traditional factors like growth or momentum or, pick a factor. And really kind of this concept of memeability or meme factor, if you will. And that's kind of continued throughout the year, right? So you had GameStop, you had AMC, you had Doge. I mean, even in crypto, this is the case too, right? You had Dogecoin, you had Shiba Inu. And you could even make the case that, Tesla is the ultimate meme stock of all. And kind of we said, what if we were able to, based on data, put together an index of securities that was kind of representative of this factor. So we started getting to work on it. We did so many back tests, trying to figure out what was the best way to kind of capture this theme, and ultimately decided to work with a company called Quiver Quantitative that provides kind of the social data for us. And determined that a combination of heavy activity on social media combined with high short interest sets up a stock to become the perfect meme. Now, I'm not telling you guys anything you don't necessarily know, but the concept and the tools and the ability to try and identify memes potentially before they have their move or even just to capture a basket is something relatively new, right? The data wasn't there 3, 4, 5 years ago, nor was the level of activity what it is now. And I think ultimately decided to create the the meme ETF as a way for people to put on a trade with regards to this factor. So I'll stop there and see what questions you guys have. But one high level thing that I'll just leave you with before I do is kind of this whole concept of meme stocks and just price being what price is, and maybe and sometimes disconnected from fundamentals or even technicals. In my view, is kind of, I don't mean to sound romantic about it, but so almost kind of the purest expression of markets and capitalism. And you know, in a lot of ways, kind of the entire meme story is almost a macro story and more about excess liquidity in the system and the Fed continuing to be accommodative. Now we can talk about whether that'll continue. I have no idea. 3 rate hikes next year is what they're calling for, but and that's kind of it. So that's why we created the ETF. Happy to answer any questions, go in whatever direction you guys want.
I have a question. So on the paperwork, it says to your provider, they make the ETF for the list every 2 weeks, so bi-weekly.
Yes.
So don't you guys miss the initial move? So let's say, for example, a stock
Yep.
ABC is getting hyped up online for a week, right? And the stock pops 100%. So won't you guys buy it after the pop, or how does that work?
Yeah,
No,
I take
it's
that.
okay. Go ahead.
So I guess the first thing is we have to be mindful of turnover. Transaction costs are very real when you're talking about such a frequent rebalancing frequency. For reference, stuff like SPY and the Russell are rebalancing once a year. Our thematic ETFs, our thematic equity ETFs rebalance once a quarter. This fund is rebalancing every other week. So, if we were rebalancing like weekly or even daily, almost all of the return would probably get eaten up by the spread, because these names are meme stocks for a reason, right? They're volatile. They have some of the highest implied volatility of any stocks in the market. I ran the numbers the other day, but we're expecting a beta of like 2.6 to the S&P because the average implied volatility of our holdings is like 75% versus something like the VIX, which is at 30. So these are super volatile names, and our thesis is people are talking about them because they're running up, and it's distinct from momentum. In that momentum is a much more like slow moving play, I think, whereas this is kind of a factor that is really fast paced, based on a combination of sentiment and short interest. And these highly shorted names, they're likely to remain highly shorted, over a period. Like if you look at GME, for example, the squeeze took over a month to play out. So that's kind of the reason for every other week.
Yeah, and just to add to that a little bit, we looked at doing more frequent rebalances. As Mario mentioned, transaction costs with a fund certainly come into play. But also, even if you do a daily rebalance, for example, let's say you did it at the close every single day, even in that, you have kind of rebalance timing risk. And I think a really interesting example there is, some of these, there's trend following ETFs out there that kind of base their exposure on moving averages. A lot of them will use the 200-day every month or every quarter, whatever it might be. And inherent in that, right? Even if you shorten the time frame, you're always going to have some element of risk there. But one thing I will add is that I think there's also Mario mentioned the fact that these kind of exponential moves often take place over a period of kind of more than 1 or 2 days typically. And on top of that, there's also a buy the dip element that we've seen in terms of the way that kind of the data plays itself out. But it's absolutely a great question.
Yeah.
And we didn't find that there was anything additive to kind of use a more frequent rebalance strategy.
So I kind of want to ask a little bit of the opposite side of that question as well. Did you guys, obviously, when you do the testing, you kind of maybe even test the other way? Was there anything you found maybe doing it, like if you were to rebalance it once a month or something? Was there something specific that kind of like, oh, okay, 2 weeks is kind of the perfect middle of all of them?
Yeah, so we looked at weekly as well as monthly. Monthly, it did feel like you're still not often enough to really kind of have the potential to capture these moves. And for context, just so everyone understands, maybe it's helpful if I give you an explanation about how it actually works. So every 2 weeks, we run a screen on the entire universe of publicly traded U.S. equities. And we look at the 50 companies with the most mentions as per Quiver Quantitative. We actually looked at using sentiment scoring. They have Quiver is something really interesting where they track the number of certain types of emojis tied to certain stocks. If we found that there's still a bit of noise in sentiment data out there, right? They're trying to use machine learning and things of that nature to say, oh, was this a bullish post or was this a bearish one? That's still kind of getting worked out. But really, we look at the 50 companies with the most number of mentions. So what are people talking about over the trailing 2-week period? And then from that list, that subset, we then look at the companies within that 50, the 25 companies that have the highest short interest. And we also are using short interest data provided by a firm called S3 Partners that actually is updated in real time much more frequently than the exchange reported data, which we think is an interesting element of all of this. And kind of when we looked at it monthly, you really had the potential to miss the entirety of a move, whereas biweekly actually if I'm remembering properly, biweekly actually outperformed weekly. And that combined with the fact that there would be less, constant turnover, is where we kind of ended up. Now that said, there's a lot of turnover amongst kind of the bottom grouping, but I don't need to tell you guys that Clover, Wish, AMC, GameStop, the Trump SPAC, all of those have kind of been have had staying power within there, at least over the past couple months. Maybe we could talk a little bit about how ETFs work and how flows work into an ETF, if that's at all of interest.
No, 100%, 100%. I feel like this was kind of a big topic that I was hearing a lot with Kathy and the ARK ETFs for a while, and I know people had a lot of talks, and I feel like you had some good tweets about what actually is happening on the back end, so I would love it.
Sure, yeah, no, it's actually my pinned tweet, but I feel like sometimes it's always easier to talk through it and have anyone ask questions that would like. So I guess kind of 101 how an ETF works. So I guess at the very highest level, I think it's important to understand that there are two types of market participants broadly in markets. One is natural buyers and sellers, people like yourself, that are selling a stock, buying a stock, shorting a stock, covering a stock, whatever you're doing. And then there are market makers. And market makers are not in the business of typically taking risk and taking a view on the direction of a stock. And that's similar to the way that they view ETFs. So let's say we launched the meme stock last week. Typically you'll see an ETF seeded with anywhere from $0 to $5 million. That's what it will start with. And let's say one of you goes out there and tries to buy 100 shares of ETF ABC. So there's actually we won't even say it's a new ETF. So let's say you go to put in an order for 100 shares of ABC. There's either two types of people that will sell it to you. One would be someone else that had bought it already. So if I had bought QQQ and I was selling it to QQQ to you, great. That trade is done. I sold. I no longer have 100 shares. Now you have 100 shares. That part's easy. But what oftentimes happens in ETFs is what's called the creation process. And in that scenario, when you go to buy 100 shares of ETF ABC, there's no one natural that wants to sell it to you. Everyone's buying, let's say. So instead, what you'll have is a market maker that sells you 100 shares of the ETF. But the market maker doesn't want to be short the ETF. So instead, what they'll do simultaneous to that, right when they're shorting you 100 shares of ABC, they will turn around almost instantaneously and buy all of the underlying components of the ETF in the exact weightings that comprise the current basket. So if you think about it, they're long all of the underlying stocks in the ETF. At the same time, they're short the ETF itself So they're perfectly hedged. If the underlying stocks go up, they're fine. If the underlying stocks go down, they're fine. And they will do that trade again and again and again until they get to a certain size of that, of the number of shares of the underlying basket that they hold. And then at that point, they will turn around to us as the issuer, actually deliver to us all of those shares of the underlying companies. And in exchange, we'll say, okay, this looks good. This matches what we currently have. We'll give you brand new shares in ETF ABC. And that's the way that the creation process works. And that's the way that assets grow for an ETF over time. And the reverse is what's called the redemption. But I think it's important for people to kind of understand these mechanics because, I think a lot of people are under the impression that, there's all of this trading going on within the ETF itself, when in fact, oftentimes, most of the trades in an ETF, sorry for the background noise, I'm in New York City, most of the trades in an ETF are actually done by market makers that are hedging underlying against the ETF itself, and depending on where supply and demand is, either creating new shares or redeeming old shares. Hopefully that explanation was somewhat helpful.
Yeah, and really quick on premium and discount dynamics. So ETFs and closed-end mutual funds are unique in that they have a net asset value, which is basically you take all of the shares or bonds or whatever securities are in the product, and you take the weighted average of them, and that's your net asset value. So, for example, let's say you have a fund, and every single stock in the fund is $100. So the net asset value will be 100. Now, the net asset value can deviate from the price. So you can have a price of 101, even though the quote unquote true worth of the underlying is 100. So if you have 101 price and 100 net asset value, that's a premium of $1 or 1%. Conversely, you can also have a discount. You might see discounts in times where the market is stressed and people are using the ETF as a way to quickly put on risk, or at times when the underlying isn't trading. So we see this typically with foreign markets, with foreign equities, or with the bond market. It's very prevalent in that most bonds barely trade once a week, let alone every day. So you'll see the ETF as a tool of price discovery. So let's say you have an ETF and the premium is material, 1%, 2%. The market makers who are collecting these shares and are waiting to exchange those shares for a unit of the fund might say, okay, the premium right now is 1.5%. I really want shares. I really want shares of the ETF because I can deliver these underlying securities and then in return get something that's 1.5% above its net asset value. So that's why at times you'll start to see creates, even when there's not significant volume, but there is a significant premium, because it's also a way for the market makers and authorized participants to make money themselves. And that's part of the whole ecosystem. It's that they are economically incentivized and advantaged to make premiums, to make creates when there are premiums, and to redeem when there are discounts, because they make money off of it. So a lot of times, especially in my old role, I would get questions on how do you know that this thing won't start to go to like a 20 or 30% premium? And that's because there's always an economically incentivized and advantaged party at the other end that stands to either deliver shares and receive the ETF, or redeem shares and receive the and deliver the underlying ETF, which would cause a redemption.
No, that's absolutely a great point, because it explains that kind of these market makers that serve, by the way, like a very critical function in the way that this whole thing works. They are arbitrageurs. They are not, once again, like I said at the beginning, interested in expressing a view, either bullish or bearish. They're instead interested in, as Mario mentioned, selling at a premium to the net asset value and buying at a discount. And they will do that trade over and over and over to the tune of millions of shares, insofar as they have the balance sheet, right? The literal cash to be able to put on these trades.
Yeah, and they all have their own models that determine what is a premium and what is a discount. It's rare that you find two parties on the street that agree on what the premium is, just because everyone has slightly different valuation models. Now, with a portfolio that's 100% US equities like meme, it's a lot easier. You just use the last trading price essentially. But with more sophisticated stuff like emerging markets, with bonds, with fund-of-fund type structures where an ETF is actually holding shares of another ETF, and then you have to consider both the price and the net asset value of those underlying things. It could start to get really complicated. And that's why you'll see different authorized participants every day on the creation and redemption side, because what's economically advantageous to one isn't necessarily advantageous to the other.
Fascinating. No, I love that lesson on the underlyings of ETFs. Truthfully, I feel like so few people on FinTwit know what's actually going on in the back end there. I've heard some crazy stuff on these spaces when you bring up Q&A or whatever. Someone tried to argue for 10 minutes. There's no such thing as market makers anymore. I wish you guys were there for that one. Could have easily defunct that. But perfect. Yeah, listen, I would love to keep it moving. Gav, I would love to throw it over to you if you have a question.
One of the questions that I have is looking at the current holdings within the meme ETF. Some of them have pretty low short interest. So I guess maybe if you could just explain for us, I'm not sure that all of them seem to me like they totally fit into the outline of what's listed here. I think specifically I saw maybe like Crowd or a couple of others that were in there. I'd have to relook. I'm seeing the top 10 holdings right now. I think like God, what was it? Like AMD's pretty high weighted in here. Crowd's pretty high weighted. I maybe would have to double check the short interest, but it didn't seem like it was that high in comparison to some other stocks which have incredibly high short interest. So I was just wondering, what that weighting is like.
Yeah, so just to clarify, the weighting when we do the rebalance every 2 weeks, it's always equal. So 25 stocks will each be at 4%. What you see now is a function of the way the prices have moved relative to one another over the last rebalance, which was last Wednesday or last Tuesday's close. So so I wouldn't read too much into the relative weightings. They're all going to be right around 4%. But coming back to what I mentioned earlier, we're working with a data provider for the short interest as well. So you can, in terms of the short interest that you're likely getting from any source that you're looking at, the exchanges only report short interest every 2 weeks. And depending on what that calendar looks like, that can be very different from what the actual short interest is at a given point in time. The short interest data provider we use via Selective is called S3 Partners. You may have seen them on Twitter before. And really, they are providing short interest that you can go check it. Will be, in our view, hopefully more accurate, but more representative of right when we're running that rebalance, what does short interest look like? And in some ways, I kind of find it interesting even looking at what's in the meme index, because I'm as surprised as you are sometimes. I would not have thought that, using one of your examples, that CrowdStrike had really high short interest. Now, it could have been that the day right before we did the rebalance, some fund put on a really big short and that impacted it. But it's really, in a way, it's kind of informative to understand how the short interest is changing for a lot of these names.
Thanks, Will.
So kind of going into that a little bit. So
sorry.
Oh, go. My bad.
No, I should actually clarify one more thing for you, Wolf, which is the way that the universe is dictated. You actually touched on a really interesting point, which is, if you recall, the way that our methodology works, we start with the broad universe of U.S. securities, and then the first screen is to find the 50 that are most mentioned as per the social data. So the biggest screen is actually happening on the social data, because it's our view that the short interest part's kind of a kicker to try and get in front of potential squeezes. But the biggest driver for a meme stock is, are people talking about it? So we take that whole universe down to 50. And then from that 50, we're taking the half with the highest short interest. So you bring up a good point, which is the actual short interest for these stocks is higher than some of the others in that 50, but relative to other securities just generally in the market might not be as elevated. So I should clarify that. That's a great point.
Shout out to everyone for coming and listening. I know they're not here anymore, but big shout out to Roundhill, Will, and Mario for joining in and making this possible and doing the spaces with me. Big shout out to Wolf Gav and Gavin for coming in and helping me kind of co-host it. And final big shout out to all the speakers for coming in and hopefully getting a little bit of value and possibly a little bit of entertainment as well.